The CPF Special Accounts gives a steady per-PP guaranteed interest of 4% per annum and is one of the safest and most stable ways to grow your wealth. But in a world of rising costs, inflation and investment opportunities, the question is, could your CPF SA be working even harder for you?
Correct that witch.
In this video, I will show you what are some of the funds that have outperformed the CPF SA, how much more you can earn if you have invested your CPF SA, and whether it is truly worth investing your CPF SA or not. But before I start, do join my 10,000 members Telegram chat group to discuss or ask any questions that you may have. So, unlike our CPF OA, which has a lot of approved investment options, the list of products that you can invest with your SA is quite limited. You are not allowed to invest your CPF SA funds into ETFs, REITs, or individual stocks. In fact, CPF SA investments are restricted to low to moderate risk products only. And there's a good reason for that. The CPF Special Accounts is primarily meant to grow your retirement nest egg safely. So the government doesn't want you getting itchy fingers and YOLOing it into some high-risk investments that could end up wiping out your hard-earned savings. Because of these restrictions, you won't be able to invest your CPF SA into many of the high-growth funds out there, like the S&P 500 Fund, Global Equities Fund, or a tech-heavy growth fund, and that kind of sucks. But here's the good news. Just because you can't invest in high-risk funds doesn't mean you are stuck with low returns. Quick pause. If you're looking for the best brokers to kickstart your investing journey, check out Interactive Brokers. You will enjoy one of the lowest fees in the industry at just 35 cents per trade on the US stock market. It also offers Ireland domiciled ETFs, perfect for saving on dividend withholding taxes. Plus, it also comes with free company research tools, so you can make smarter investing decisions. Feel free to use my Interactive Brokers link to open an account and start investing today. Alright, let's get back to the video. If you head over to the FSN1 Fund Selector page, filter by CPF SA investments, and sort them by 10-year performance, 3 funds in particular will stand out. The first one is the Schroder Multi-Asset Revolution Fund, which delivered an average return of 5.3% per year over the past 10 years. Then there's PineBridge Accounts of Asia Balance Fund, which has averaged 5.6% per year since inception. And finally, the First Sentier Bridge Fund, which also returned 5.6% annually since inception. So what does this mean for you? Well, let's say you invested $2,000 of your CPF SA into one of these funds every year for 20 years. That extra 1.3% return as compared to the CPF SA 4% interest could add up to an extra $45,000, which is a lot of money, yeah? And if you later transfer this into your CPF retirement account, it could mean an extra $300 in payouts every month from the age of 65. That's more than enough money to fly to Thailand every month, eat tom yum, get a Thai massage, and stay one night and fly back. But here's the question, is it worth doing this? Not the Thai massage part. That won't confirm worth it. I mean the investing your CPF SA part. Because while those funds have outperformed the CPF SA 4% interest over the long term, even the fund managers themselves are quick to remind you that past performance is not a guide for future performance and may not be repeated. And they are not wrong. Take the Schroder Multi-Asset Revolution Fund as an example. Yes, it delivered a solid 5.3% average annual return over the past 10 years. But much of that performance was driven by the incredible run of the US stock market in recent years. For example, in years like 2019, 2020, 2021, 2023, and 2024, the fund delivered returns of around 10% or more, largely because the S&P 500 was surging with 20+% returns during those same years. But if you rewind the clock a little, it tells a different story. In the 2014 fact sheet, the fund had only achieved a 2.8% annualized return since inception. Go even further back to 2012, and it was only 2.2% annualized. In other words, the impressive 5.3% figure we see today is very much a result of recent US market strength and not a guarantee of future performance. This is also what many financial advisors tend to do, where they will show you a list of top performing funds from the past year and be like, nah, just choose from this. This is a classic case of recency bias, where we assume that just because something performed well recently, it will continue to do well in the future, which is not always true, yeah? But for argument's sake, let's say we have entered the era of US exceptionalism, and from now on, this fund consistently gives a 5.3% average return. Wouldn't this make the Schroder Multi-Asset Revolution Fund worth investing in? After all, a 5.3% return is clearly better than CPF SA's 4% return, right? Well, not quite, because the 4% return is guaranteed and you confirm plus chop get it every year, whereas the 5.3% return is just an average return and it doesn't guarantee that you will always get it every year. Some years may be great, while other years may not be so great. To understand what I mean, check out this simulation. It compares the outcomes of investing in the Schroeder fund versus simply leaving your money in your CPF SA over a 20-year period. Even though the Schroeder fund has an average return of 5.3%, it underperforms CPF SA about 30% of the time, which is pretty frequent. This can happen for a few reasons, such as the US markets doing poorly for extended periods, or if it crashes early in your investment journey, something known as sequence of returns risk. And the worst part, you are taking on all that risk and volatility just to chase an extra 1.3% return, which is like not a lot. Now, you might be wondering, but isn't it also risky to invest CPF OA? Yes, the key difference is that the risk to reward ratio is much more favorable when investing in your CPF OA. Check this out. Here, I'm comparing leaving your money in CPF OA, which earns 2.5% interest, versus investing it into the Amundi MSCI World Fund, which has an average return of 8%. Over a 20-year horizon, the Amundi fund outperforms CPF OA in about 90% of the simulations. What this tells you is that while investing in your CPF OA does come with risk, if you choose your investments well, the odds are much more in your favor and you are being properly rewarded for taking on that risk. This is also why it is not always a good idea to transfer your CPF OA money to SA, because even though you can get an extra 1.5% guaranteed return, the opportunity cost of doing so is quite significant. By locking your money into SA, you're giving up the chance to invest the OA money into higher return assets such as global equity index funds or properties. Worse still, OA to SA transfers are irreversible and you lose the flexibility to do anything else with your SA money. In contrast, taking investment risk with your CPF SA, which already gives you a guaranteed 4% interest, comes with a far worse risk to reward trade-off. Not only you will possibly not get your free Thai massage every month, you could also potentially mess up your retirement plan at the same time. In short, the 4% guaranteed return from CPF SA is super good. And when you compare that to an investment that only gives you 1% more on average, it is not really worth taking the risk, especially when that 1% isn't even guaranteed. To justify taking on that kind of risk, you will need to find an investment that consistently delivers much higher returns. And sadly, at the moment, nothing in the CPF SA approved list fits that bill. So instead of always trying to squeeze out the maximum possible return from every dollar, a better mindset is to think of your CPF SA as your retirement safety net. Because even if all your other investments boom and fail, your CPF SA will still be there, quietly compounding at 4% a year to take care of you when you retire. Also, if you are thinking of topping up your CPF, it might make more sense to top up your CPF Medisave account before your SA, since Medisave gives the same 4% interest as SA, but the funds are more flexible. You can use the money to pay for some of your healthcare expenses, such as health screenings, hospitalization, insurance premiums, and even surgical dental expenses. Anyway, that's all for this video. Hope you found it useful. Like, share and subscribe as I'll be posting new videos every week.